For this chapter here we have in order for you to, in case you miss something in my lecture, you need to go through Shirin 3, which talks about opportunity cost. Among other things, you need to go through a document titled Revenues, Receipts, and Returns. This is a document called Revenues, Receipts, and Returns. You need to go through a document on Shirin 9, which is a document on costs, comprehensive document on costs. Let me repeat again, in case you misunderstanding anything on my lecture here, you need to go through three things: Shirin 3, Shirin 9, a document on revenues, receipts, and returns. It is one document. And also there is a document on, a fourth document on, it's called a word on profits. These are the four supporting documents to the word, to the PowerPoint that is displayed on chapter 6 here. Let me repeat again. In addition to what I'm going to be covering today, you need to go through Shirin 3, Shirin 9, a document titled Revenues, Receipts, and Returns, and a document titled a word on profit. Four supporting word documents that need to accompany what I'm going to be talking about today. Okay, because in case you misunderstanding anything of what I'm going to be saying today, you have lots of examples and lots of explanations mentioned in the four documents I just mentioned. Shirin 3, Shirin 9, these are two word documents, in addition to another two word documents, one of them titled Revenues, Receipts, and Returns, and another word document titled A Word on Profit. Today we'll talk about, I'm going to give you a quick definition of, first of all, why I want you to go through all that, because remember, in production theory, okay, we assume that the producer, the individual producer, wants to maximize profit. The reason for any entity, any commercial entity, anything that you see that is called, that has a web link called .com, .com. .com, it means .commercial. .commercial, it means that this business or this entity is there for one reason only, is to make money out of you. Making money out of you, it means simply to maximize profit or to maximize net returns, depending on how do you see things, and to see the difference between what is profit and what is net returns. So in order for us to do that, because remember the objective of any business, the objective of any individual producer, okay, and when we say business, we mean an entity that organizes, manages the business and assumes risk. What does it mean, assumes risk? It means that accepts risk. It means that while you aim at maximizing profit, which is a good thing to do, you might encounter losses as well. And that's why you say you have to assume risk. You have to accept risk. Okay, risk, it means that you can make money and you can lose money. And the more possibility for making money, it means the more possibility for losing money. Okay? So the profit or net returns has three components. Revenues on the one hand, costs on the other hand, and the difference between both will be either net revenues or net receipts or net returns or profit, depending on how do you define cost. Remember when we said revenue, let us say that we assume that, let us say that we assume that we have only one output, just for simplicity, that my business or I as an individual producer produce one output only. I'm going to call it Y, capital Y. In that case, my total revenues, okay, will be P of Y, which is the unit price of output, times Y, which is the amount produced of output. Okay, P of Y is definitely measured in monetary units, such as pounds or dollars or anything else. And the level of output is measured in physical units, like kilograms, tons, meters, depending on what you are producing. So total returns or total receipts or total revenues is equal to P of Y, which is the unit price of output, times Y, which is the amount of output. And the units of measurements of revenue in that case, which is called the total revenue, okay, is monetary units, for example, dollars or pounds or anything like that. Another name for total revenue, as you saw in my previous lectures, remember the tables through which you calculated how much of the variable input I should use to maximize my profit or my net returns in the examples that we saw. Another name for total revenue is total value product, or TVP. So actually, we have for revenues, we have it is total revenues, total receipts, total returns, total value product, or TVP. All of them are the same. It means, what all of them mean? All of them mean one simple thing. They mean how much money the business or the factory or whatever or the individual producer will receive when that individual producer sells something in the market. How much money that will pour in. How much money that the business will receive. It doesn't mean anything more than what I just said. How much money you will get as a result of selling what you have. If you sell or you produce one output only, such as Y, capital Y, in that case, your total revenues, your total receipts, your total returns, your total value product in that case will be P of Y times Y, the unit price of output times the amount of produced output. The shape of that function, okay, usually we measure it, we say that the shape of that total revenue function is exactly similar, actually identical to the shape of the production function. Okay, which means that the more, remember when we graph total revenue or total receipts or total returns, we graph total revenue vertically on the vertical axis, and we always put output on the horizontal axis. Please remember the following: for all the cost curves, revenue curves, profit curves, output measured in physical units must be put on the horizontal axis, and the money, depending on whether that is revenues, receipts, or profit, or net returns, or whatever, is measured on the vertical axis. In that case, if you put output measured horizontally in physical units, and if you put total revenue or total receipts or total value products or total returns measured on the vertical axis, in that case the shape, the true shape, let me say the true shape of the total revenue function will be exactly identical to the production function, which means that as the level of output goes up, revenues will increase at a decreasing rate. Revenues will reach a maximum, after which revenues will decline. Okay? Don't ask me why revenues will decline. It's a long story, but in reality this will happen. Which means that you cannot increase revenues indefinitely by increasing the amount of output that you produce or that you sell, for a very simple reason. You remember, when the price of the product, remember we assume that it is constant, the P of Y is constant. But remember, the more the producer supplies things to the market, the more I put things on display in the market, the more abundant that will be, and as a result the price of which will go down, assuming that the demand is constant, at least in the short run. So do not think that the more you display in the market, the more you will sell. Because yes, the more you will sell given that you reduce the price. Okay, but in general, total revenue function, the true shape of total revenue function is that it is a quadratic function. When you measure output horizontally and total revenue vertically, it means that as a level of output goes up, total revenue will increase at a decreasing rate. It will reach a maximum, after which it will decline. Sometimes, for simplicity, they graph total revenue as a linear function stemming from the origin, showing that the more you sell, the more revenues will increase at a constant rate. This is just for simplicity when we assume a linear demand function. Why do I say a linear demand function? Remember, because here we said that P of Y times Y. P of Y times Y is a linear function. But remember here, it's a linear function because we do not consider the true shape of the production function, and the true shape of the production function is either cubic or quadratic. But just for simplicity, we know that, let us for now say that when we graph the total revenue function, we measure output horizontally and the total revenue vertically, and the shape of the function is either linear, in case that for the very simple thing, which means that the more you sell, the more you obtain total revenue, okay, or it takes in reality, as I told you, the shape of the production function, okay, which means that the more you sell, total revenues will increase at a decreasing rate. Okay, now this is for revenue, and as I told you, I have a long Word document, Microsoft Word document, titled Total Revenues, Total Receipts, or Revenues, actually it's titled Revenues, Receipts, and Returns. And remember, there is another name for that. Also, for total revenue, it's called the total value product, which we introduced, remember, in our previous class, previous online lecture. When we said, remember, in the tables that I showed in my online lecture too, okay, when we introduced the money to our story about production theory. Now I want to address, actually talking about the revenues is very easy, because any idiot, as I told you before, can know how much revenue a business can make. Okay, just know. It is very easy. Why it is very easy? Just know how much you sell in a certain period of time. Okay, let us say per month. How much do you sell per month? Multiplied by, let us say that for simplicity you are producing one output, multiplied by its unit price. This will be your total revenue. But can you judge, okay, can you judge that the business is doing great or not just by looking at total revenues? And the answer is definitely not. Because any business never aims at maximizing total revenue. Business want to maximize the difference between total revenues and the total costs. This is very important. Do not ever think that because you see a restaurant, for example, so crowded with people, okay, you hardly find a table to sit in. And in order for you to eat at that restaurant, you have to make reservations. Okay, it shows one thing only. It shows that the restaurant makes a lot of revenue. Why? Because the restaurant in that case sells a lot of meals, okay, and as a result they earn a lot of money. But you cannot judge whether that business makes profit or not, because in order for you to do that, you have to look at the cost side, and looking at the cost side, despite that looking at the revenue side is very straightforward, looking at the cost side is very tricky, and a lot of businesses do not know, lots of businesses do not know about the calculation of their costs. So now let me introduce the other side of, remember in our previous online lecture too, we said that, remember, we determined the level of the variable input X1, which will maximize the net returns of the individual producer, which is the difference between total revenue and the total variable cost, not total cost. Now let me go through the types of costs that we have here, just to give you an idea about cost. Again, if you want to know more about revenues, please go to my documents titled Revenues, Receipts, and Returns. Okay, now, what about costs? In economics, we have different classifications of costs. Okay, one of these classification of costs classifies costs as explicit and implicit. Explicit, as it says here, any cash expenditure paid directly to acquire resources such as labor, chemicals, repairs, fuels, whatever. Okay, it is an amount of money that people can see. Okay, usually we call the explicit costs, we call it accounting costs. This is the type of costs that accountants are interested in, and it is the type of costs that only accountants consider. Okay, it is actually any cash or any credit card payment. It is called the implicit cost. If you write a check to somebody, if you give him cash, if you pay by credit card, for example, in addition to so many other forms that I would not want to go through here, because they are actually, if you study advanced economics, the story is much more than that about explicit costs. But to you, at least at your level, you understand that explicit cost, which means that it is the type of cost that can take the form of either payment in cash or payment by credit card or payment by check, just for you to imagine this type of cost. Okay, the implicit cost, it has another name, remember. Okay, now suppose that I have one variable input. Remember, let us here in this example, he mentioned so many variable inputs. Okay, remember, this is one variable input, labor, chemicals, another variable input, fuel, another variable input. Okay, in case you are talking about agriculture, for example, seeds, another variable input, fertilizer, another variable input, and the story continues. Water use, another variable input, and so on. So if I assume that I'm going to have only one variable input, which is, remember in my story so far, I'm assuming that I'm having one variable input and one output. Okay, So in that case, my total variable cost in that case will be P of X1 times X1, which is the unit price of the variable input X1 times the amount used of the variable input, which is X1. Okay. Remember, I have a number of fixed inputs such as X2 all the way to Xn. I'm not interested in those for the moment. Okay. So the explicit cost is any cost that is paid to acquire any factor of production. Okay. Now, what are the implicit costs? We already covered that explicitly in our course. I talked about that 1,000,000 times before this semester, I mean, and I talked about that to the people who are studying economics this semester only. Implicit cost has another name. They call it opportunity cost. Okay, it is a type of cost that you encounter as a producer if, for example, you use your own land. You are using my own land. So the question is, if I use my own land, what is the price that I should put for my own land? Accountants tell you nothing because it is your own land. Suppose that I am managing my company. I am the manager and I am the owner of the company. And so I am paying myself a salary because I am the working, doing the job of the manager. In that case, to the accountants, there is no wage and there is no cost for doing the managing job because you are the manager and you are the owner, which is not true in economics. In economics, even though you are the manager and the owner, we say that your salary is actually based on what you could have earned somewhere else and you didn't because you are managing your own work. It is a type of opportunity cost. It is a type of a sacrifice. Okay, so this is for the explicit and the implicit cost. Explicit cost, it has the name accounting cost. Implicit cost, it has the name, another name called opportunity cost. Another classification of costs could be according to their type in terms of relationship to time. So we have something called the fixed cost. We have something called the variable cost. Fixed cost, it is FC or TFC, it means the total fixed cost. VC or total variable cost, it could be also called the TVC. They are the same. As I told you here, it says here, fixed cost is not related to the level of output in the sense that no matter how much money no matter, as long as you have a business, you have to have fixed cost. As long as you have a business, you have a fixed cost. In order for you to know more about that part, please go to Shreen 9. It is titled Costs. Okay, it has great details about all these type of costs. What are the types of costs that are not related to the level of output? What does it mean? First of all, the meaning. What is the meaning of the word not related to the level of output? Remember, when I graph fixed cost, as you will see later on, too bad I cannot move forward in my slides, because if I move forward to show you a graph on my slides, I cannot come backward. I cannot go backward. I cannot go backward. And the reason is this is because remember I'm video recording right now. So unfortunately, in video recording, if I move forward, I cannot come backward to a previous slide. But as you will see that when we graph fixed cost, we graph fixed cost vertically, and we graph a level of output horizontally. And then we make the total fixed cost function looks like a line parallel to the horizontal line, which tells you that whether you produce zero level of output or any amount of output, assuming that you can produce indefinitely, total fixed cost will not be unchanged. And that's why we say that it is not related to the level of output. Once you have a business, you have to pay fixed costs. And I told you about fixed costs here for the people that I told them, that in case you remember before or you don't remember, they are depreciation, interest, repairs and maintenance, taxes, and insurance in addition to rent. These are the 6 main types of fixed costs that are used in the science of economics and could be understood at your level. And a huge explanation about all these terminologies are located in Shreen 9 Word document. Okay, but let me go through them quickly to tell you why they are fixed, why they are not related to the level of output, why when every producer as long as you have a business, you will pay them whether you like them or not. Okay? Let us say, for example, that my business is a boutique. Let us say a restaurant, just for the fun of it, because we like to eat food. Remember, we are people in general. Examples about food is really entertaining to everybody. It is used extensively, examples of food in all economics textbooks. Why it is fun to talk about. Suppose that my business is a restaurant. I am an owner of a restaurant. Okay? Suppose that my restaurant, let us say I shut it down and I went home and I slept for a year. What is the type of cost I'm going to be paying because of that? It is called depreciation. What is depreciation? It means that the value of the restaurant as a building, okay, with everything in it will go down as a result of the passing or the passage of time. Remember, everybody depreciates. As time goes by, you get older. Physically, you deteriorate. Okay? I know that mentally you appreciate, but physically you deteriorate. Exactly. So depreciation is a reduction in the value of the asset, which is the restaurant in that case, as a result of the passage of time. Okay? This is the impact of time on the building, on the status of the building. We know that every building, okay, actually everything, not every building, everything in life, the value of which goes down with the passage of time. Okay? So deterioration of the building, which we call it depreciation, means the value of the building goes down as the result of the passage of time. It is a fixed cost. Whether you produce from the restaurant, whether you open it or you don't, you will pay it anyway. It is a cost. The value of your restaurant will go down because the building will become older and older and older as time goes by. Another type of cost is called interest. What is interest? Interest is a type of money. Let us say again, I'm gonna tell you now. My example is always I am an owner of a restaurant. I'm gonna shut it down for a week. I'm gonna close it for a whole year. Now the question is, what is interest that I will pay despite that I'm not producing anything? And the answer is, suppose that you took loan from the bank to have that business. In that case, the interest will be the interest rate that you have to pay the bank, okay, as a result of taking a loan from the bank. Let us say that, okay, remember what is interest in that case. Let us say that I took £1 million to start my business as a restaurant. In that case, the bank doesn't care whether I use whether I open the restaurant or I close the restaurant. The bank will tell me, okay, Habibi, because you took £1 million from me, you are supposed to return it a year from today as £1,100,000 because the interest rate is 10%. They don't care whether I opened the restaurant or I did not open the restaurant. They don't give a shit to that. What they care about is that you took $1 million. The interest on that million is 10%, which means that a year from now it has to be returned back to the bank in the form of £1,100,000. So it is not related to the level of out, which means that it doesn't relate to how much meals do you offer or how much or whether the restaurant is open or not. Now suppose that I used my own money. Let us say that I am rich enough, I did not take any loan from the bank and I used my own money. And the question is, am I going to be paying interest or not? Okay, for those smart students who remember the previous slide when we said that we have something called the implicit cost, and the answer will be yes, there is an interest even if I use my own money. What is the interest that I will encounter and I will pay even if I shut down my restaurant, by the way? Remember my example, I'm talking about fixed costs, the type of cost that I will pay anyway as long as I have a business, whether I'm opening it or not. The question is, suppose I use my own money. Suppose that I have $1 million and I used my million. And the question is, am I going to be paying interest? And the answer is yes. Why? Because suppose that there is an implicit cost here, opportunity cost. Suppose that I did not use my £1 million in that business. What else I was going to be doing with the £1 million? And the answer is simple. At least I was going to deposit that £1 million in the bank, because if I do that, I will earn interest. Suppose that if I deposit that money, £1 million in the bank, I was going to earn, let us say, 10% interest. In that case, what I am going to be losing, what I'm going to be paying as interest by using my own money in the business will be the amount of interest I sacrificed, which means I did not get, which means I have foregone as a result of using that £1 million in my business. So the point here is that whether you take a loan from the bank or you don't to have your business, anyway, you will be paying interest. If you take a loan from the bank, the interest in that case is an explicit cost. Okay, it is a money that you have to return back to the bank. If you use your own money, the interest in that case will be what you could have earned and you didn't. Okay, because you used your £1 million in the business. Okay, so you lost the interest that you could have gotten and you didn't because you used your money in the business. So this is the second type of fixed cost. The third type of fixed cost is called repairs and maintenance. What is repairs and maintenance? Repairs and maintenance, this is, remember, I have a restaurant, I am an owner of a restaurant, I am shutting it down for a whole year. What is the repairs and maintenance that I have to spend if I shut my restaurant for a whole year? It is the minimum amount of maintenance that I have to do to the business in order for that business to be operatable when I want it to be operatable. Okay? To make that example very clear, let us talk about a car. Suppose that you bought a car and you put it in front of your home and you left it unused for a year. Be sure that after 1 year, when you come back to the car trying to use it, it will not be working. Okay? Why? Because you have to do some sort of maintenance. You have to spend an amount of money of maintenance, okay, on the car in order for you to find the car operatable at the time that you want it. And the same thing applies to the restaurant. Okay, so repairs and maintenance, it is another type of fixed cost that is not related to how much you produce. In that case, what is production? In the case of owning a restaurant, it is the number of meals I offer. Remember, I am shutting my restaurant down for a whole year, but I'm still the owner. Another type of tax and another type of fixed cost that I have to pay that is not related to the level of output is taxes. Okay, once you are an owner of a business, Habib Albi, you will be paying a lot of taxes to the government. Why? Because you own a restaurant. They don't care whether the restaurant is working or not working. As long as you are the owner, as long as it is legally registered, you have to pay taxes. And taxes is a long story in economics. I'm not going to go deep in that. Another type of cost, fixed cost that I have to pay if I have a restaurant or I have a business, in that case, even if I shut it down for a year, is insurance. Okay, remember people who, businessmen, business persons, business people, business women, entrepreneurs, when they have assets they are afraid to lose, they insure them. Okay, the insurance company will charge you the premium anyway, whether the restaurant is open or not. They don't care. Okay, you're not going to say, hey guys, sorry, I bought a restaurant, but I did not open it. Okay, so there is nothing to be insured about. They don't care. As long as you insure it, you have to pay the premium. Otherwise, the contract with the insurance company will drop. Another example of fixed cost that is not related to the level of output is, we said what? Rent. Suppose that I did not own the restaurant to start with. I did not own the business, but I rented. I rented and I shut it down. Okay, I'm sure that all of you now know, okay, because remember people have apartments that they do not use, okay, but as long as you rent them, the owner, your landlord in that case, which is the owner of the building, doesn't care whether Habib Albi you are living in the apartment or not. As long as you pay the rent, it means that you are renting the apartment and you have to pay the rent, even though you are not living there. And the same thing for the restaurant. If you do not own the restaurant yourself, but you rather rent it, you have to pay the rent. Otherwise, the real owner of the restaurant will tell you, okay, sorry, I'm not going to rent it to you. Do not pay the rent. You are out of it. Okay. So these are the types of fixed costs that are not related to the level of output. And when we say unrelated, it means that whether you produce a lot or you produce a little or you produce nothing at all, like the example I gave you, I'm shutting down the business. I'm going to close the restaurant for a whole year. You will have to pay all of this: depreciation, interest, repairs and maintenance, taxes, insurance, and rent in case that you rent the business and you do not own it. When we graph, despite that, remember, despite that, I said that fixed cost, as it says here in that lecture, on that slide, it is not related to the level of output. Actually, it is. When we graph it, we put output measured in physical units horizontally, and we put fixed costs or total fixed cost to measure vertically, and we graph it, as you will see later on, a straight line parallel to the horizontal axis to indicate that you will be paying this amount of money, which is the amount of fixed cost, whether you produce 0 or you produce any other positive units. Variable costs, these are the type of costs that goes up with the level of output and goes down with the level of output. Remember that, let us say we're talking about we have one simple variable input, x1, okay? Now, I'm going to put total variable cost measured vertically and output measured horizontally. Remember, in order for me to produce more, I have to use more of x1, given some other fixed inputs. So, in that case, my total variable cost will be P of x1 times x1. The more I produce, the more my total variable cost will be. The less I will produce, the less my total variable cost will be. If I do not produce at all, like the case that I told you, I'm going to be shutting down my restaurant for a whole year. In that case, my total variable cost will be 0. Why? Because I'm going to be using 0 x1, because I'm not producing anything. And as a result, the P of x1 times 0, it will be 0 total variable cost. Let us now see how the shapes look like. Okay, before I go to that, again, as I told you, I have to go through it slide by slide. Okay, profits, okay, means the difference between receipts and expenses. What is receipts? Receipts, I told you, it has so many names. Receipts, total value product, total returns, total revenues, they are all the same. Total receipts, total value product, total returns, total receipts. Expenses, the expenses, it means the summation of total fixed cost plus total variable cost. When you subtract total cost, which is total fixed cost plus total variable cost, from total revenues, you obtain profit. But when you subtract total variable cost only from profit, when you subtract total variable cost only from total revenue, you obtain net returns or net receipts, okay, and not profit. Profit is the difference between total revenue and the total cost. Total cost is total fixed cost plus total variable cost. But net returns, this is the thing that we maximized in my previous lecture. Okay? It is the difference between total revenue and the total variable cost only. Fixed cost is not in the story that we covered in our last, online lecture too. Okay? So here we said generally, profits, the difference between receipts, which is total revenue, and total cost. If total cost is more than total revenues, you will have a loss, which is says here. A loss here, which means a negative profit. Okay? That you are losing money rather than making money. Okay? And we said here, this is a repetition of what I mentioned before about accounting and economic profit. This is an example I'm going to show you in a moment. It's a numerical example that tells you the difference between the science of accounting and the science of economics. And after that, we'll go to see how the curves look like. Okay? Accounting profit, okay? It means the profits calculated from the point of view of an accountant. It is equal to revenues minus all operating costs, direct and overhead. Overhead here, it means fixed. Okay? Direct here, it means explicit. We use the word overhead cost to indicate fixed cost. Why we call it overhead? Because it is over your head whether you are using the business or not. Okay? So, when you subtract all operating costs minus revenues, if you subtract all operating costs from revenues, which is revenues minus all operating costs, okay? If these costs are explicit, okay, which means that you can see it, okay, and you can direct, it means you can see it and it is variable, plus the fixed cost. If you subtract that from revenues, it will be accounting profit. Economic profit, okay, sometimes we call it pure profit, and sometimes we call it rent. It is sometimes to indicate economic profit. It is revenues minus total costs, fixed and variable. And when we talk about fixed and variable here, we talk about implicit cost or opportunity cost is included in the story. So in general, as it says here, how do they compare? In general, economic profit is always less than accounting profit. Because in accounting profit, we account for all and we include all types of costs. Okay? In economic profit, we include all types of costs, explicit and implicit. So by definition, remember, implicit is not included in the story here. Okay, and as a result, in general, economic profit is always less than accounting profit. Okay, and this is an example about the difference between accounting. Forget about AED here. AED, it means Arab Emirates dirham. Okay, AED here, it means the money. Imagine here we put pounds or we put dollars. Okay, dollars or pounds. So here, suppose that this business sale is 500,000 pounds. These are the business sales. Okay, this is from the accountant point of view and from the economist point of view. Okay, and all these numbers are monetary numbers. Okay, in that case, okay, so this is the revenues. How did you obtain the revenue? It's very simple. If I produce one output only, multiply the amount of output, amount of sales يعني, by the unit price of output. Okay. Now, what are the costs here? Okay. This is purchase. The guy purchased inputs, let us say, for example, 250,000. Okay, which is the same as for the economist and for the accountant. Utilities, these are water, electricity, and everything else. Let us say 50,000 in both. Labor wages, it is the same. It is the amount of money that I pay to my workers in my company, 70,000 and 70,000, they are all the same. Now we come here, what is the difference here? Own wage. It means that if I pay myself, I am the owner of the business. I am managing the business because I'm a businessman. I am managing the business and I'm paying myself an amount of salary or amount of income in that case, because it is actually payment per month or per year. It doesn't matter whether, if you look at it per month all the way, just consider it per month, per year all the way, it doesn't consider it per year. Okay? So all these numbers are the same. So let us say that I'm paying myself 50,000 pounds a month. Okay? If I'm an economist, I'm going to include that in the cost. If I'm an accountant, the accountant will tell you that you are paying, you are yourself. Okay? So it's not accounted. Okay? It is not included in his story. Okay? But it is included in the economist's story. Depreciation is included in both cases. Okay? This is a loss in the asset value. Okay? So here, this is again 22,000 pounds. Okay? And here it is 22,000 pounds, but divided into two parts. Loss asset value, it is this 10,000 pound is the loss that will happen to the value of the building with the passage of time. Because time passes by, the building depreciates in value. The value of the building goes down. Okay? And this is the interest, because in that case, if I take money, I loan money from the bank. Okay? So despite that, both of them, to the accountant, as you see here, okay, it is 22,000 pounds. To the economist here, I calculate only the loss in the value of the building. And the interest is the same in case I take a loan. Here, I don't know actually why the guy is making the loss in the asset value less than the depreciation here. Okay, I don't know why the depreciation figure here is more than the depreciation of the figure here. Okay, it's not clear. But this is not the point that these slides want to show you. Okay, here we have the same interest. Okay, here, remember here I'm using my own money. The interest on using my own money here is not included here. This is very important. So what is important here is the following. The own wage, let me make it in red. The own wage is included. Oh my God, let me erase it again because it crossed it out. Okay, let me use pink. Own money here, it is not there. Own money here, it is not there. Okay, and as a result, when you add total costs, here you will find the total cost for the economist is more than the total cost for the accountant, and as a result, profit, which is total revenue minus total cost, will be less for the economist from the point of view of the economist compared to the point of view of the accountant. Despite that, as I said here, the accountant made the depreciation calculated as 22,000 pounds, while it is only here calculated as 10,000. Okay, this is a general rule that happens for everything from the economic perspective and from the accounting perspective. Economic profits all the time must be less than the accounting profit, because in economics we calculate in the calculation of profit. Okay, despite that, from the accounting point of view and from the economic point of view, profits are total revenue minus total cost, and total cost is fixed plus variable. But when we talk about costs in economics, we have to include the implicit cost, which is, as it says here, I am hiring myself, paying myself £50,000. It is not. It is included by the economist in the cost, not included by the accountant. If I use my own money, the interest foregone, the interest that I sacrificed as a result of using my own money in the business is included in the story, but it's not included in the accountant story. And as a result, economic profit is always less than economic profit is always less than accounting profit. Okay. Here we'll talk about the short run and the long run. I told you about that 1 million times, I think, in my classes. I think you guys got sick of it. It is a time concept that has to do with what you are talking about. Okay? Short run and long run, in production theory, reflects the ability of the firm to change and to adjust resource use. In the short run, there are some inputs that you cannot change their amounts. Why? Because you are out of time or out of money or out of both. Okay? So you have, in the short run, you have, to make the story simple, you have fixed inputs and you have variable inputs. For the fixed inputs, you have fixed cost, and for the variable inputs, you have variable cost. In the long run, everything is variable. There is no classification for inputs to be fixed or variable, and as a result, there is no classification for the cost in the long run to be fixed or variable. All costs in the long run are variable because everything is possible in the long run. But in the short run, which is the type of analysis that we are using throughout our course, we assume that we have fixed inputs and variable inputs, and as a result, we have fixed costs and variable costs. Okay, as I told you, let us say that we talk about, for example, a farmer. A farmer can have example of fixed inputs are, for example, a laboratory, okay, an animal house. These are expansion of land, okay. That could be done, but in the long run. But it's going to be done in the short run because we're out of time and out of money. In the long run, everything is variable, and you have lots of examples about short run and long run in my Shireen document. So please go through it. I'm not going to go through that again because I myself got sick of it. Okay. These are the calculations that you have to remember. Okay. Why we say short run here? Because this is a type of thing that I told you that we will be doing all the time, short run. So in our analysis, we have to assume that we have fixed inputs and variable inputs, and as a result, fixed cost and variable cost. Okay. Now, we have what is called the total cost curves and what we have unit cost curves. What is the total cost? Total fixed cost is TFC, total variable cost is TVC, total cost, which is TC, is equal to TFC plus TVC. Unit cost, if you divide each one of them by the level of output, you obtain the unit cost. So average fixed cost is equal to total fixed cost multiplied by the level of output. Remember, the units of measurements of all what you see on the graph here is monetary units. The only thing that is not in monetary units is the level of output measured in physical units. But when you divide total fixed cost by the level of output, you obtain an amount of money, which is, for example, suppose that you divided total fixed cost by the level of output, money by kilograms. What do you get? It is the share of the single unit of output of total fixed cost. Suppose that it's equal to $5. So what does it mean, $5? It means that the 1 kilogram of output, okay, imposes $5 or has a share of $5 of your total fixed cost. Average variable cost is total variable cost divided by the level of output. Again, it gives you the contribution or the share of the single unit of output of total variable cost. Okay. Average total cost is equal to total cost by the level of output. Again, it tells you the share of the unit of output of total cost. Okay. Marginal cost, it is the change in total cost with respect to the level of output, which is the same as the change in the level of total variable cost with the level of output? The reason is the change in the level of total fixed cost with the level of output is zero. So marginal cost is either what will happen to total cost when the level of output goes up by 1 unit, or what happens to your total variable cost as the level of output goes up by 1 unit. And the reason is TFC, delta TFC is equal to 0. Now we're going to give you an example, a numerical example here. This is the production function. Here I'm having that example, okay? This example is a little complicated, but please listen to it, and that's why I'm going through the lecture here. Here we are having that we have 2 variable inputs in addition to a number of fixed inputs. Anything after this sign, you see this sign right here, okay? It means that what is to the right of it is fixed cost. So we have fixed cost here, x3, x4, x5, all the way to xn. We have 2 variable inputs, x1 and x2. But here we are gonna, because remember we are using two-dimensional graph, okay? So in that case, we are gonna hold the amount used of x2 as 40 units only. So here I'm gonna fix the amount of x2 at 40 units all the time, okay? And I'm gonna change the level of x1 and see what will happen to y. Okay, and this is the complication that we have it here, which is the mixing of your understanding of what is a fixed input and what is a variable input. X2 here is a fixed input. Sorry, X2 here is a variable input, but the amount of that variable input is fixed at 40 units. And I am going to change the level of X1 and see what will happen to Y. Here the market price or the unit price of output is $1 a unit. The unit price of the variable input X1 is $5 a unit. The unit price of the variable input X2 is $2.5 a unit. Okay? Costs of all other fixed inputs assumed to be $50, which means that the amount of money that I pay for X3 all the way to Xn is $50. Okay? Let us again, because I'm not gonna be able, again, if I move to the next slide, I'm not gonna be able to go back to the previous slide. Let me tell you here. Remember, here I'm using all the time 40 units of X2. The unit price of X2 is $2.5 a unit. Then the cost of using X2 is 2.5 times 40. Okay? 2.5 times 40 is how much? Is exactly $100. Okay? So remember that we have $100, which is the amount of money paid in order for me as an individual producer to use these 40 units. Okay? So remember, 40 times 2.5, which is P of X2 times X2, is $100. I am paying this $100 all the way because I'm using, it is constant. It is constant at $100. Why? Because I'm using all the time 40 units of X2. Okay? But the level of X1 goes up. The more I use X1, the more the total variable cost of X1 will go up. Okay? And P of Y is equal $1. Okay? The other remaining cost is 50. So here, in order for me to determine my total fixed cost, it will be 50 plus 100. Why 50? Because 50 this is the amount of money that I pay to obtain, because I have X3 all the way to Xn. The fixed cost of $50 here, it is the cost of depreciation, interest, insurance, repairs and maintenance, rent, taxes and everything else. Okay? Remember, 50 in that case must be added to 40 times of 2.5 because I am holding constant the amount of X2 at 40 units. And the unit price of that is 2.5. So 2.5 times 40 is 100. 100 plus 50, this will be my total cost, my total fixed cost, $150. Okay? And this is the table that you see here. Here I am using, these are the units of X. Remember here, X2 is held constant at 40 units. Okay? And here this is the amount I am paying. The word AED, as I told you, take it away and put dollar instead. Okay? X1 here is measured in physical units. Y is measured in physical units. What does it mean physical units? It means non-monetary unit. Okay? So these are the only two variables, Y and X1, that are, the three variables here, these are measured in physical units. Okay? Kilogram, tons, whatever, yeah. If they are talking about labor, it will be number of workers, anything like that. If we're talking about fertilizer, it will be bags of fertilizer. Okay, physical units, which means not money. Anything to the right of x2, okay, all the way here is measured in monetary units. Okay, so here when I use, remember, every time I'm using 40 units of x2. Okay. Now I'm going to change the level of x1 and see what will happen to y. I'm assuming here in my example to be simple, to start from the origin. If I use 0x1, I'm going to produce 0y. After that, if I use 11.6 units of x1, I'm going to produce 100 units of y. If I use 17.6 units of x1, I'm going to produce 200 units of y. If I use 43.9 units of x1, I'm going to obtain 600 units of y, and the story continues down there. Okay? x2 is held constant at 40. These are the fixed cost of using x3 all the way to xn. My total fixed cost in that case, as I told you before in my previous slide, it will be 50 plus 2.5 times 40, which is 50 plus 100. It is all the way 150, as you can see here. Okay, this is my total fixed cost, which is the cost that I pay for obtaining for the depreciation, interest, insurance all the way for x3 all the way to xn, in addition to using a constant amount of x2 of 40 units multiplied by its unit price of 2.5. So this is the fixed cost. Now total variable cost here in that case will be P of x1 times x1. Okay? So I don't remember what was P of x1. It was mentioned before, but I forgot it. Okay? Multiplied by the amount of x1, you obtain total variable cost. Now when you add total fixed cost, total variable cost, you obtain total cost. Okay? What is total revenue here? Total revenue is P of y times y. Remember, P of y was $1. So here, that's why total revenue is the same figure as total as y. Y total revenue here, the column that's called total y. Total revenue here is measured in dollars. Okay, but remember, we obtained it by multiplying P of y times y. P of y is 1. 1 times 0, 0. 1 times 1, 100. 1 times 100 is 100. 1 times 200 is 200. 1 times 300 is 300, and the story continues. Profit is total revenue minus total cost. 0 minus 150 is minus 150, which is a loss of 150. Okay? This is not a negative variable, habibi. Huh? This is not a negative variable. It means that rather than you achieve a profit, you are achieving loss. Loss is another variable. If I take away profit and put profit or loss, in that case, I will not put the minus. But the reason I'm putting minus here, because I'm talking about profit only. So because I'm talking profit only, I mean negative profit. What does it mean, negative profit of $150? It means that you are losing $150. Okay? I could have put a variable called loss, or I can put that variable as profit slash loss. Okay? So this is not a negative variable. Huh? It is a negative profit, 150, or a positive loss of $150. And the same thing here. This is 0 minus 150. 100 minus 208. It is a loss of 108. And the story continues all the way down. Now, remember, my objective as a producer is to maximize profit. Okay? Where is the maximum profit here that we got? Okay? The maximum profit that we got here is 261. This is the maximum profit. Okay, this is the highest number in that column, profit. Okay, how did I get it? If I produce 700 units of output. Somebody will tell me, yeah, doctor, I also got it when I used that amount of variable input. This is not the story. Remember, in production, okay, we care about the level of output. Remember, I told you before, we found a formula for identifying the level of the variable input that will maximize profit. And I told you that it is the level of X1 at which value of marginal product of X1 is equal to unit price of X1, or MPP of X1 is equal to P of X1 divided by P of Y. This is the amount of X1 that you should use to maximize your net returns. Here, I care about the level of output that if I produce will maximize my profit. In that case, if I produce 700 physical units of output, I will obtain the maximum profit of 261. Okay, this is the table that I got. Now, do we have an economic rule that tells the individual producer how much output he or she should produce if they wanted to maximize? the profit and the answer. But before I do that, let me show you the curves. Again, here we're having money measured vertically. Okay, AED, it means the dollars. And this is the level of output measured horizontally. Total fixed cost will be that pink line. It tells you that whether you produce 0 or you produce 810, you are paying the same amount of $150. Total variable cost, it means that if you are using 0 amount of X1, then your total variable cost is 0, and total variable cost will go up, okay, in that manner if you increase the level of X1. Total cost is the summation of the blue line and the pink line to obtain the yellow line. And the yellow line will look exactly like the total variable cost line, but stemming from that point right here, which is 150. Okay, this is the shape of the three curves that we took. These are the shapes of the money is measured vertically and steel output is measured horizontally. This is the 0 line, as you can see. The thing in yellow is the profit function. Okay, it was negative before, and then it kept going up all the way, okay, like this. Okay, so total cost will be the blue line. Okay, total revenue will be the pink line. The difference between both, I want them to be maximized. Okay, and in order for it to be maximized, the total revenue must be greater than total cost, which will happen by producing 700 units of output. This is what is written here in this slide. Okay, these are the shapes of the average variable cost, average fixed cost, average total cost, and the marginal cost. Okay, here again I'm measuring money vertically and level of output again horizontally. The average variable cost, it is the dark blue line. Okay, average variable cost looks like a dish. Okay, a deep dish. Okay, and the same thing for average total cost, another deep dish, but above it. Okay, average fixed cost is a curve, this curve that looks like that, which means that the more output you produce, average fixed cost will keep declining, but it will never be 0. Okay, and if you see that the numbers start from the vertical axis, this is not of importance in our work. In reality, they never start from here because they are. This is done for simplicity. But these are the shapes of that graph. I'm going to show you on another slide, inshallah, a better, or I'm going to send you a document. I will not be able to, I'm going to send you a document that shows how, remember I told you, I sent you before a graph that shows the true production function. I'm going to upload it on your Google Classroom course for better cost curves. How do they look like? Because this graph is not actually clear to show you how the marginal cost curve look like, how the average variable cost look like, how the average fixed cost look like, how the average total cost look like. But like remember when I talked about marginal physical product of the variable input, average physical product of the variable input, and the production function and the relationship, there is a relationship here. The reason actually that these curves look like that is because of why. Remember the origin, we know in economics which one came first, the chicken or the egg. We know that the chicken came first. What is the chicken? Is a production function. The reason for all these shapes, for total fixed cost, total variable cost, total cost, average fixed cost, average variable cost, average total cost, and marginal cost is because the production function is the way it is. Okay? But I'm going to send you on another another occasion, I'm going to send you how these curves will look like. Okay, but remember you can graph them. Okay, all you need to do, you can graph them separately if you want. For example, you measure money. Let us say I want to measure average fixed cost separately. Okay, I'm going to measure vertically average fixed cost and horizontal level of output and connect to the point. I want to measure average, I want to graph average variable cost separately. Put average variable cost vertically, put output horizontally, connect to the points. I want to measure average total cost separately, put average total cost vertically, put output horizontally, connect to the points. I want to obtain marginal cost separately, put marginal cost vertically, put output horizontally, and then use the numbers that you have in the previous table and connect to the points. If you do that as an exercise, as a homework separately, okay, then you can see how do the, and then put them collectively in the same graph, okay? In that case, of course, the scaling of the graph when you do every curve separately is much easier than if you do them collectively. But just do it as a homework. You will learn a lot. Trust me. Okay, and these are the rules that similar to the rules that we mentioned before when we talked about marginal physical product, average physical product of the variable input, and the total physical product. Okay, when we talked about production theory. Okay, here it tells you that average variable cost and average total cost, they look like a U-shaped. They look like the letter U. They look like a deep dish. Okay, but average total cost is a deep dish that is above average variable cost all the time. And the difference between the two curves is average fixed cost. Average variable cost reaches minimum before the minimum of average total cost, which means that the level at which average variable cost reaches will happen at a level of output that must be less than the level of output that happens when you obtain minimum of average total cost. Average fixed cost declines all the way as the level of output goes up. And the reason is simple, okay? Average fixed cost is total fixed cost divided by the level of output. As the level of output goes up, the denominator gets bigger and bigger and bigger. But total fixed cost is constant, which is the numerator. And that's why as the level of output goes up, okay, which means as the denominator goes up, average fixed cost will decline all the way. Marginal cost is falling, okay, and it will reach a minimum, and that minimum of marginal cost will happen at a level of output that is less than the level of output at which average variable cost is at a minimum, and the level of output at which average total cost is a minimum. Okay, so marginal cost will be at a minimum level, okay, at a level of output that is less than that level of output where average variable cost is at a minimum, and where that average total cost is at a minimum. I'm going to send you again better documents for that thing. I'm going to tell you to go through it, but they are not shown. I don't know if they are shown on PowerPoint or not, but I will send you the true graph in another document, not in my lecture here. These rules that you see here are very similar to the rules when we talked about, okay, marginal physical product reaches a maximum at the inflection point on the total physical product or production function. When marginal physical product is increasing, output or total physical product is increasing at an increasing rate. When marginal physical product declines, it means that output increases at a decreasing rate. Okay? When marginal physical product is equal to top of average physical product, then this is the beginning of stage 2. Okay, when marginal physical product is 0, then average, then total production is maximum. It is similar to that story. Okay, I will send you inshallah graphs that explain that much better. Okay, and I'm going to upload it to you on your Classroom, Google Classroom course website. This is the remember the difference between, remember in economics we try to maximize profit. We do not try to maximize output. We never maximize output. Okay, we never maximize sales. We never maximize that. We maximize profit. So here I copied, this is the same level of output, which is Y, the same total revenue that we got before, the same profit that we got before. And he calculated here average fixed variable cost, average fixed cost, average total cost, marginal cost, and marginal revenue. Let me go to marginal revenue first. What is marginal revenue? In a perfectly competitive market, which is the type of market that we assume for both inputs and output, we assume that this is the market price. This is the price that you get if you sell one more unit of output. Remember, P of Y, which is how much the producer gets as a result of selling one unit of output, is $1. Remember, P of Y is equal to 1 if you go to the previous slides. P of Y is equal to 1. P of Y is another name for marginal revenue. Okay? Why? Because marginal revenue is how much the producer will add to his total revenue or to her total revenue as a result of selling one more unit of output. Okay? Which is what it will be, the unit price of output. If I sell one more unit of output, how much money I'm going to get? How much I'm going to add to my total revenue? It is the unit price of output. So MR is the same as the unit price of output in a perfectly competitive market. And that's why it is $1 anyway a unit, whether you produce 0 or you produce whatever, 810. Now, average variable cost is total variable cost divided by the level of output. Okay? So here for this one, why it is undefined here, and why it is undefined here, and why it is undefined here? Because I'm producing 0 here. Okay? So as long as I'm producing 0, there is no production, so there is no average. Because the average of any variable cannot be 0. In the science of math, in order for the average variable to be 0, it means that all the values of that variable must be 0. Okay? And that's why it is undefined here. After that, average variable cost here, for this one, for example, this one is equal to what? It is equal to average variable cost. It is equal to, actually here total cost is not shown on that graph. So in order for you to calculate average variable cost, you have to divide total variable cost by the level of output. Okay? And in order to obtain average fixed cost, you have to divide total cost by the level of output. And in order to obtain average total cost, you have to divide total cost by the level of output. Okay? And the total cost, unfortunately, is not shown on that graph, and that's why I cannot show how it is done for you. Okay? Marginal cost, I told you here that it is marginal cost, I told you here is that it is the change in the total variable cost or the change in total cost as a result of the change in the level of output. Okay? Here, what is written here, actually it is wrong. Okay? This 0.58 should be on this line right here. Okay? And you should have put a hyphen here, undefined. And instead of this 0.58, you put it undefined. Okay? The reason the author of this slides, which is not me, by the way, but I'm thankful for him, okay, for doing it, is to show you that in the end, the economic rule will tell you that the level of output that maximizes profit is that level of output okay, he want to show you that it is the level of output that maximizes profit is that level of output at which marginal cost is equal to the unit price of output or marginal revenue. That's why he put it like that. But you do not need to do that, because you need to look at marginal cost and the marginal revenue in order to determine how much output will maximize your profit. Okay? By looking at the two closest numbers in this thing, in these two columns. What are the two closest numbers here? Imagine that I'm going to move that column all the way from up to down. So 0.58, I'm going to put it here. And 0.3, I'm going to put it here. And 0.26, I'm going to put it here. And this 0.26, I'm going to put it here and put it down. In that case, you will find that here we will have 1, and here we will have 0.7. Okay? And in that case, you will see that the level of output that maximizes the profit, in that case, will be 700 units. It is not necessary to have identical equality between marginal cost and marginal revenue. But the economic rule tells you the following. Produce, if you, as a producer, and if you want to maximize your profit, produce, and if you are operating in a perfectly competitive market, you have to produce the level of output at which the marginal cost of output is equal to the marginal revenue of output. Knowing that the marginal revenue of output, which is the addition to total revenue of output as a result of increasing the level of output by 1 unit, is the same as the unit price of output. So the economic rule tells you that if you want to maximize your profit, produce the level of output at which the marginal cost of output is equal to the marginal revenue of output, okay? Or produce the level of output at which the marginal cost of output is equal to the unit price of output, because the unit price of output in a perfectly competitive market is the same as the marginal revenue of output, and this is the economic that you see right here. The optimum level of output, which is the profit maximizing level of output, is that level of output at which marginal revenue of output, which is the same as unit price of output, is equal to marginal cost. And this is where my lecture here, online lecture 3 will stop. okay? Because what comes next after that is much more complicated, okay? And that's why I want you just to understand this for the time being, okay? This is the rule. Remember that I don't know if I uploaded homework to you on Google Classroom or not. I'm gonna check. But anyway, please follow up on Google Classroom for your course to see the homeworks and to practice the practicing thing that you need to do in order to understand. And if you have questions, you know how to refer to me. WhatsApp is or Google Classroom, definitely. If you have a question, I can answer it there, or you can put it on, ask me the question on WhatsApp so I can give you a voice message, okay? But in general, this is the main thing that we got out of that lecture. It is given, remember, we know that we covered the costs and the revenues, and as a result, we covered the profit. But here, the moral of that online lecture 3 is determination of the optimum level of output, which is the level of output that maximizes the individual producer's profit, which is to produce the level of output at which the marginal cost of output is equal to the marginal revenue of output, knowing that in the perfectly competitive market, the marginal revenue of output is the same as the unit price of output. Actually, marginal revenue of output is the same as the unit price of output and is the same as the average revenue of output as well, which is total revenue divided by the level of output in a perfectly competitive market. This is the optimality rule. If you want to maximize your profit, please do not produce the maximum that you can produce. Never do that. We do not maximize the level of output in economics. We maximize profit, which is the difference between total revenues and the total costs. Okay? And in order for you to know how much exactly you should produce, stop the level of production when you reach the level where by producing one extra unit of output, you will add to your total revenue the exact amount that you will add to your total cost. This is where you should stop producing, because if you continue production beyond this point, you will add to your total revenue an amount of money that is less than what you will add to your total cost. And as a result, profits will keep declining. Thank you very much. Hope I was of some help. I know it might not be that easy, but I will supply you with some homeworks that will make your life easier. Thank you very much. Stay safe. See you in my next online lecture. Bye-bye.